Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at PDD holdings.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis.
Okay, let's start with the foundation, the numbers. Because when you look at the financials for PDD, it's really something else.
It really is. The Q1 2025 results were, incredibly strong.
And not just from sales, right? This would jumped out at me, the non-operating income.
Exactly. We're talking about interest and investment income hitting over 5 billion RMB in a single quarter.
So that's just money they're making from their cash pile.
Yeah, that's not revenue from someone buying something on Pinduoduo or Temu. It's a sign of immense financial strength, separate from the core business.
It shows they're not just surviving, they're
Yep.
compounding.
And that sits on top of a massive operation. The total revenue is getting close to, what, $400 billion?
But revenue is one thing, profit is another.
Right. And their pre-tax profit margin is holding steady around 7.4%. That's real earnings power. They turn that massive revenue into actual profit very efficiently.
For me, though, the real kicker, especially right now with all the economic uncertainty, is the balance sheet.
Oh, absolutely.
They're sitting on zero long-term debt.
Zero. It's almost unheard of for a company that's scaling this aggressively on a global level.
So they're funding their own growth. No need to go to the markets for cash.
It gives them a huge strategic advantage. They can weather shocks that would crush a more leveraged competitor, and they have the liquidity to back it up.
You mean the current assets?
Yeah, over $415 billion in current assets. It's why their financial condition score is a 9 out of 10. They have so much dry powder.
Which flows into how they use that capital, right? You mentioned their ROIC is high.
Extremely high return on invested capital. It just means for every dollar they put back into the business, whether it's for, logistics or machinery, they get a huge return in profit. They're just masters of capital efficiency.
So, okay, the financials are pristine,
Yeah.
but how do they protect that? What's the moat that stops a rival just undercutting them on price?
And that brings us to the core advantage, the consumer to manufacturer model, the C2M model.
Right. For anyone who hasn't heard of C2M, can you break that down simply?
Think of it like a giant digital matchmaker instead of a factory guessing what people want to buy.
And then making a million of them and hoping for the best.
Exactly. PDD's platforms like Pinduoduo and Temu, they aggregate all the customer demand first. They see what people want, they group it together, and then they go to the manufacturer.
So the manufacturer is producing exactly what's needed in huge volumes.
Precisely. You cut out the wholesaler, the distributor, all the middlemen, and that's how the prices get so incredibly low. It's not just a pricing strategy, it's a completely different cost structure.
And that creates a feedback loop, doesn't it? It's not just about the transaction.
It's social commerce.
Yeah.
The group buying, the viral sharing, it creates a really powerful network effect.
More users means better data.
Better data means more efficient manufacturing, which means lower prices.
And lower prices attract more users. It's a virtuous cycle.
And they're using that to build scale everywhere in the lower tier Chinese markets and now obviously internationally with Temu.
Temu is leveraging that exact same advantage globally.
Yes, and that lets them undercut competitors by a huge margin. Now, part of that does rely on certain, let's say, geopolitical advantages, like duty exemptions and subsidies.
Which is a massive lever for growth.
But as we're about to discuss, it's also the source of their biggest headache right now.
Okay, so speaking of that headache, let's talk about how the market is actually pricing all of this in. Because with a balance sheet like that, you'd think it would trade at a huge premium.
You would think so, but that's the big surprise here. The valuation metrics tell a very different story.
The PE ratio is, what is it, under 10?
It's sitting around 9.73. I mean, to put that in perspective, that's a valuation you'd expect from a slow-growth utility company, not a global e-commerce giant with zero debt.
It definitely signals potential undervaluation. But what's the recent price action telling us? Is the market waking up to this?
We're seeing some signs of life, for sure. There was a big 5.89% surge on December 19th. And then pre-market on the 22nd, it was up another 2% or so.
So there's some accumulation happening.
It looks like it, but you have to see that in the context of the recent pain.
The 15.5% pullback over the last month.
Right. The stock is basically digesting that drop right now. Technicians would call this an accumulation phase. It's finding support.
What are the key levels they're watching?
Well, it's holding right around its long-term moving averages, the 50-day and the 200-day. When a stock pulls back to those lines and holds, it suggests the sellers are exhausted and buyers are stepping in.
And that selling pressure brings us right back to market sentiment and the elephant in the room.
The risk. The entire reason for that 15.5% drop can be pinned on one major issue: the EU.
Yes, the EU regulatory scrutiny on Temu. Their whole low-cost, high-volume model has regulators looking very, very closely at them, especially regarding the Digital Services Act, the DSA.
And the DSA is what exactly? Why is it such a threat?
It's a huge piece of EU legislation for big online platforms. It's
Yeah.
about accountability, transparency, product safety. If Temu gets classified as a very large online platform, the compliance burden is enormous,
And the fines are massive.
potentially up to 6% of their global revenue.
hmm
But it's not just the fines. It's the risk that they could lose some of those advantages we mentioned, like the duty exemptions.
If that happens, it hurts their core ability to undercut the competition.
It fundamentally compromises the model, and that risk is what's been driving the bearish sentiment and the short-term selling.
So that's a really strong bear case. But the institutional money seems to be telling a different story. They're buying.
They are. It's a classic case of smart money looking past the short-term noise. We're seeing what's called cluster buying, like
Well, Valea Financial added over 125,000 shares. ABS Direct Equity boosted its holding by almost 79%. It's now their second largest position.
wow, that's a huge vote of confidence.
It is. It suggests they believe the regulatory risk is either manageable or maybe even already priced into the stock.
And overall institutional ownership is pretty high, isn't it?
It's getting close to 40%. The big players are in. Plus, you just had the entire board reelected, which signals stability at the top. You need that continuity when you're fighting these kinds of battles.
Okay, so let's pivot from the risks to the catalysts. What could flip the sentiment and drive this thing higher?
There are a few things lining up. On the macro front, you have potential U.S. rate cuts on the horizon, and China is still pushing stimulus.
Both of which are good for consumer spending.
Exactly. And when consumers are looking for value, discount e-commerce wins. So the macro environment could become a major tailwind.
What about a more specific company-level event?
The big one is Q4 2025 earnings. That's expected in early March 2026. The consensus is looking for significant margin expansion, driven by that C2M model, really kicking into high gear on a global scale.
A big earnings beat there would be huge.
It would be immediate validation. And then, you've got the market noise, the unconfirmed M&A chatter, the rumors about new ties to Oracle data centers.
There's a lot of speculation.
A lot of speculation. But the real catalyst, the thing that would unlock this, is any positive news on the regulatory front. If they can remove that EU overhang, all the technical and fundamental forces are aligned for a major rally.
All right, so let's bring it all together. What's the final investment picture for someone listening right now?
I think the core thesis is still incredibly bullish. You have this deeply profitable company, a zero-debt balance sheet, and a powerful competitive moat in the C2M model,
But it's trading at a PE below 10.
which just suggests the market is not appreciating its long-term compounding potential. It's focused on the short-term regulatory headline risk.
And the upside could be significant if that changes.
Current price targets are suggesting upside of over 25%. The thinking is that the recent drop has basically done the job of pricing in the Temu risk. That creates a really compelling setup for a rebound when these catalysts start to hit.
So PDD Holdings represents a fascinating case study of a deeply profitable company facing immediate regulatory hurdles, forcing investors to weigh multi-year compounding potential against short-term noise.
A great point to reflect on. We'll keep tracking this story and many more. Make sure you subscribe so you don't miss our next analysis on the world of complex opportunities.